Hello everybody, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation we are using hypothetical computer simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke, and I'm a trading performance and financial freedom coach with Locke in Your Success LLC, where we help traders win in the markets and in life as well. And today I'm here to talk to you about the wonderful world of high probability options trading. Now, a high probability trade is when we put ourselves in the position so that we can make money over the passage of time rather than depending solely on price movement in order to make money. Now, this doesn't mean we're going to make money all the time, but it does mean we put ourselves in a position where it's much more favorable that we are going to have a winning trade. Now, if you're unsure of what that means, or if you have any questions or comments, feel free to contact us at my email at john@lockeinyoursuccess.com, or you can simply comment on the YouTube channel. The income strategy we're going to be discussing today is called the M3. Now, the M3 is a time-tested improving strategy that I developed back in 2007. At the time, we had no idea that it was going to perform this well over such a long period of time and such a wide variety of markets. But here we are in 2020, and the M3 just proves itself year after year after year. Not only in simulated trades, but in live trades. Not only have I been live trading this since 2007, but we also have hundreds and hundreds of students doing the same thing. So my point being that many people, including myself, have utilized the M3 not only as a trading strategy that's profitable over time, but also as a stepping stone along their path to becoming a more advanced market neutral trader. In fact, the M3 is what I call the gateway drug, or the gateway strategy to our legendary rock trading strategy, which is a more advanced adaptable strategy that has absolutely phenomenal results over time, year after year, in pretty much any market condition that we've seen in the last 10 to 15 years. So it's really an incredible strategy. For those of you who are more advanced income traders and you'd like to take a look at the rock trading strategy, we have some examples on thewinningtrade.com. We're also having a webinar this Tuesday on Options Tribe. Yeah, it's optionstribe.com, and you can go on there and you can sign up for that webinar. That's going to be the John Locke with the rock trading strategy. I believe it's called Rocktoberfest, dominating the market in 2020. So I encourage you to go on and join us there. Now, back to the M3 strategy. The M3 is a strategy that we trade on the Russell 2000. It requires a minimum capital of $5,000. Our example size is 10 times that. It's going to be $50,000. With this, we have a 10% profit target. So in our trade of $50,000 planned capital, our profit target is going to be $5,000. Our maximum loss is going to be 10% also, or $5,000. This is not entered from a technical standpoint. We're just going to enter it depending on how far from expiration we are. We enter this trading strategy 56 days to expiration, regardless of the market conditions. And once we're in the trade could last up to 56 days. Rarely do we go that long, but there are times when that does happen. Now let's take a look at the trade. So this here is a software called OptionNet Explorer. And for those of you who are not familiar with it, we have we're what we call backtester mode. So this is showing the past. We are showing the date of July 24th, 2020. Along the side here, we have our options strikes. So we have our call options at the top, put options at the bottom. This is going to be our position. So in this case here, we're selling 2014-40 September 18th, 2020 calls. This tells us is when they expire. Okay, so it's July 24th. They expire September 18th. They're 56 days to expiration. We're selling 2014-40s. We're selling the 14-40s because they are about 20 points below the market. They're actually 26 in this particular case. We're also selling the 14-40 puts. And then we're buying the 1490 calls and the 1390 calls. This gives us what we call an iron butterfly. And from there, we're also buying a call to bring what we call our delta to near zero. So this is going to end up being a positive 1.17. That's close enough. So when we take a look at this position on what we call an analytical graph, which is over here, this graph has the asset price along the bottom. It has the current profit and loss, or the profit and loss numbers along the right side. We have a triangle line, which is called our expiration line, and the expiration lines means the value of this position when the options are at expiration. So it tells us the value of the position in the future date being September 20th, 2018, or the expiration time within our options. So for example, if the Russell was at right here at 1440 on expiration day, it would be worth about an $80,000 position. Now we're getting out of this when it's up 5,000, so that would never happen, but that's what it means. And then of course, if you go out here, you'd be down money if you did nothing and you let it expire. But we're not going to do that. We have what we call an adjustment strategy on this position. So that is the expiration line. We also have what's called the T+0 line, which is this curved line that goes from red to blue to green. This is the projected value of this position, or the theoretical value of this position at any given price point today on the Russell. So if today the market went from 1466 to 1600, it's projecting that this position would be at a profit of about $2,000. Okay, and that's how that works. Over time, the T+0 line tries to match the expiration line. Okay, so here's our position here. Now, if the market goes down to the point where we have what we call a downside problem, or a risk problem of the downside, we're going to remove and reset the position. We're going to take it off and we're going to roll it back. Also, if it has too much positive delta, we're going to take it off, or we're either going to make an adjustment or we're going to take it off and roll it back. To the upside, if we get 10 points over the long strike, our long strike being 1490, so if we get 1500 or over 1500, we're going to again take the position off and move it. If we get too much negative delta, and our negative delta limit's -15, we're going to make some sort of an adjustment here, and we'll show you that as the trade plays out. All right, so here we are, 56 days to expiration. This is what our chart looks like. Not that it matters, because we don't pay attention to the market conditions as far as the charting goes. Yeah, you could if that was your style of trading, but you can also do this non-subjectively. Completely non-subjectively is how we do it in the options trading for income Monday morning presentations. So also, one other thing I'd like to point out, this is what we call a $50,000 planned capital position, but our actual capital in the position right now is only $15,500. So we're determining our profit and loss off of the $50,000. And right now, like I said, it's only at $15,000. In certain market conditions, you might get up to $50,000 in this. Also, if you bring it close to expiration and there's a lot of adjustments involved, you may also bring it close to $50,000. But as of right now, that's all we have. So my point being that a lot of times our actual percentage, our return on actual capital involved in the trades, often much higher than 10%. So let's just go from adjustment to adjustment here. And I'm going to just go to, it's July 24th. We did our first adjustment on July 29th. So what happened here is the asset price is at 1501. You can see it here and you can see it here. That's more than 10 points over our 1490 short strikes. That being the case, we're essentially going to take this off and we're going to reset it. So I'm going to hit the button here that's going to apply the trades, and you'll see our short strikes are going to move up to 1480. This is our new position. I believe we also moved the call as well, and we're just going to create relatively neutral delta, and by that I mean plus or minus 2 delta is fine. Here's our new position here. Go to the next adjustment is August 5th. So what's that, about another week or so. And at this point here, we're once again 10 points over the long strike. That being the case, we're going to roll this up. We call it rolling. We're going to take this position off. We're going to bring it up to, in this case, 1520, about 20 points below the market. And you'll see that here. In this case here, you only see 19, what we call, let me get this. You see 19 options here. That's because the long strike is also at 1520. That's what we needed for our relatively neutral delta, and we just didn't move it. Okay, so here is our adjusted position. If we go to the following day, or the following adjustment, that's August 10th. Once again, we run outside the tent here. We're up $1,092, so everything's going fine. But again, we're more than 10 points past our long strike of 1570. As a matter of fact, we're all the way up at 1588. We're 18 points past it. And we're due for another adjustment. We're going to do the same thing. We're going to look at this here. We're going to go to, in this case, 1570, which is 18 points under the money, almost 20. And you'll see that move here. So now we're short the 1570s. Short means we're negative, right? Negative short. We're short the 1570s, and we're long the 1620s and the 1520s. And our call is at 1580. Our delta is relatively flat. It's about two positive delta, so that's perfectly fine there. So now some of you might say, well, you know, boy, this seems like we're doing a lot of adjustments. One of the things you have to think about is the amount of time that's actually gone by here. We started this 56 days to expiration with 39, and we've gone by several weeks, meaning we've had to touch this maybe once or twice a week, which is actually much more often than normal. Because if you look at the price, remember this is a neutral strategy, right? If you look at the price chart, we had a very aggressive up move, and it was just in one direction, which is the reason why we've had to move it a little bit more than normal. But consider that if a trade lasts 30 to 60 days or 30 to 56 days, and you have to adjust it 3 or 4 times, that's only like once a week or so, and sometimes less than once a week. And there's other times where you get into the strategy and you don't really have to do anything to it at all. It just hits profit target, in which case you put the strategy on and you didn't do anything. So the other thing I'd like to point out too is this is not something that you watch all day. You know, it's not like you're a day trader. I mean, I look at day traders, and sure, I love day traders. I coach day traders, but day trading is almost like buying yourself another job. You have to sit there and watch the market all day. This type of trading here, like I said, you touch it every 4 or 5 days. Maybe sometimes you go 2 weeks or so, and you don't have to do anything. Sometimes longer, you don't have to do anything. And as far as checking the position, we're only just looking at it the end of the day. So you can basically come in and say, hey, you know, I only run into a problem with this strategy if the market hits this point or it hits that point. And you can look at the price of the asset at the end of the day and say, oh, I don't really have to do anything, and just let it go and move on. So it really can be as simple as that. And of course, if you do err at a place where it's close to an adjustment, you just go in and you make your adjustments and you move on at the end of the day. So, you know, this really is as passive a way to gain some freedom when you're trading and still be able to reap the many rewards of trading as well. So anyway, this is where we are as of Monday, August 10th. If I go to next adjustment here, you'll say, why are we adjusting this? It's not outside the tent. Well, the reason we're adjusting it is because we have a delta limit of minus 15 and we're at minus 19. So that being the case, we want to make a correction for that. And there's multiple ways we might do it. Sometimes we will move the call, right? I can move the call deeper in the money. I can remove some butterflies. That'll also bring it down. Or I can do verticals in here. So there's multiple things you could do. The way we do it when we're sized up at 20 contracts with a $50,000 position is we're going to move, and the call is only at 53 delta, we're just going to move the call deeper in the money. So we're going to move it from 1580, I think, to 1510. Let me look at here. Yeah, 1510. That's going to bring us neutral delta again. We're good to go. So very simple adjustment there. And then if we go to the next adjustment, let me just Actually, let's go day by day now. So on the 18th, this is what we look like here. No adjustment needed. Everything's fine. We're up $3,200. The 19th, we're up $3,500. So we're not getting a lot of price movement, but the passage of time is helping us, right? So if we go to the 20th, we're up 4,100, 4,400 on the 21st, and then Monday the 24th. Well, what happened here? Okay, let's ignore our trades. And on Monday the 24th, the trade gets up to $5,800 profit. Now our profit target was $5,000, but we don't watch this all day long. So it happens to be by the end of the day when we check it, it's up $5,800. So we're going to close it. And we're just going to sell off the butterflies, sell off the call, and we're going to be up a profit of around $5,800 or 11% on our planned capital of $50,000. Now, keep in mind though, we only had a margin here of about 24,000. We'll call it 25 to keep the math simple. That gives us about a 22% return on our actual capital in the trade in only, let's see, 31 days. So another fantastic trade for the M3 for the month of September. And that was the M3, this episode's winning trade. If you like what you see, I encourage you to visit lockinyoursuccess.com and subscribe to the winning trade. Also at lockinyoursuccess.com, you can discover how you too can follow along with this and many other great trading strategies as they unfold during our weekly Options Trading for Income webinars. Also, where you can learn about upcoming winning trade presentations and explore past winning trades and get bonus information. And perhaps best of all, you can go to the Trading Performance Podcast, where you can find information on how to skyrocket your trading results. And also while you're there, you can check out our fantastic memberships. We have a Market Outlook membership where we take a look at the markets once a week. We have our Go membership where we have our Options Trading for Income webinars every Monday morning where we track 12 income strategies through time. And then we also have our what we call a Trading Performance membership where you can skyrocket your performance through learning the success principles of traders. And then, of course, we have our Pro membership, which includes it all, the Market Outlook, the Go membership, the Trading Performance membership, plus its own fantastic information as well. If you have any questions or comments about anything you'd like to see in the next winning trade, simply comment on the video below, and we can get those questions answered for you. Also, please remember to share and to comment on our videos. It helps us, it helps you, it's good for everybody. So thank you for joining me today, and we'll see you on the next winning trade.